Hi. After numerous requests in the comments section, in this video we take a quick look at the Dow Theory and how it can be helpful in identifying trends and reversals. The Dow Theory was developed by Charles H. Dow, who was one of the co-developers of the Dow Jones Industrial Average in 1886. He published the theory through a series of articles in the Wall Street Journal, which he co-founded along with Edward Jones and Charles Bergstresser. Unfortunately, Dow couldn't complete the entire theory due to his death in 1902, and the theory was therefore expanded and completed by his associates and followers years after his death. There are 6 main tenets of the Dow Theory. The first tenet of the Dow Theory states that the market discounts everything. The Dow Theory states that the market is efficient and discounts everything known to the general public. In a stricter implementation of the theory, the markets even discount future events. If Dow Theory is to be believed, it's impossible to beat market returns without exposing oneself to higher risk. As per the theory, all available information is already built into stock prices, and neither expert stock selection or market timing can help anyone outperform the market returns. The second tenet of the Dow Theory states that there are 3 kinds of market trends. The first is a primary trend that lasts a year or more, such as a bull or a bear market. Within the primary trend, there are intermediate, secondary trends that are formed against the primary trend, like a pullback or a short-term correction. The duration of secondary trends can be between 3 weeks and 3 months. Then there are minor trends that last less than 3 weeks and are considered noise. The third tenet of Dow Theory states that the primary trends have 3 phases. The primary market trends go through 3 phases before they reverse. In an uptrend, the markets see an accumulation phase, a public participation phase, and an excess phase. In the downtrend, the markets see a distribution phase, a public participation phase, and a despair phase. Dow Theory states that indices must confirm each other. As per the Dow Theory, a trend gets established when all the major indices or market averages move in tandem. If the major indices point in opposite directions, the trend is not conclusive, and traders should be cautious. Dow used 2 indices, namely the Dow Jones Industrial Average and the Dow Jones Transportation Average, to prove the tenet. The theory was that if the economy was indeed healthy as indicated by the DJAA, the railroads should also profit, and the DJTA, which was formed of railroad stocks, should also move in tandem with the DJIA. For me, this part of the theory is now outdated. The fifth tenet of Dow Theory is that volume must confirm the trend. As per the Dow Theory, the trading volume should increase when the price is moving in the direction of the primary trend. So, for example, if the index is in an uptrend, the volume should be higher when the index is moving up and lower when it's moving down. If price moves in the direction of the primary trend with lower volumes, then it's assumed that the trend is not strong and a reversal might happen. This part of the theory still holds true today. Whether it is the direction of trend or a breakout trade, the volume should also be aligned to the move. The sixth tenet of Dow Theory is that trends persist until a clear reversal occurs. As per the theory, a trend is considered to be in force until a clear reversal occurs. Investors and traders must understand how to identify reversals and how to differentiate them from secondary trends. Also referred to today as technical analysis, this part of the theory refers to the breaking of support or channel lines. Let's now understand how to interpret and implement Dow Theory. A follower of Dow Theory trades only in the direction of the trend, and therefore it becomes necessary to understand how to determine which trend is in force and how to identify the reversal as it happens. Dow suggested peak and trough analysis to determine the direction of the trend. In this analysis, price is said to be in an uptrend if it's hitting higher highs and higher lows. On the other hand, the trend is said to be reversed when the price fails to reach new highs and breaches previous low levels, making lower highs and lower lows. The downtrend is deemed to be in place if the price keeps on hitting lower lows and making lower highs. The downtrend reverses when the price breaches the previous high and makes a lower low. The theory can be used to identify the trends and reversals in individual securities as well as in broader markets. It gives a bird's eye view and microscopic view of the direction of the trend, which is of great help to a trend-chasing trader or investor. Let's now understand some limitations of the Dow theory. The Dow theory was formulated in the 1900s using the structure of the economy and the market indices at that time. It's been more than a century since the theory was formulated, and the structure of the market and underlying economy has completely changed over time. For example, the US market has moved away from industries to technology companies, rendering the industrial indices like DJTA non-existent and unusable. The other limitation of the theory is the emphasis on the efficient market hypothesis in its first tenet. There have been many examples of active managers beating the market returns through expert stock selection and market timing, which is a complete contrast to the theory.